Let's talk about the banks, because Jim is in and out of a trade, which didn't do you too well, Jim.
Yeah, well,
FRC.
so just to remind people, I did two things last week. I bought the KRE, the Regional Bank Index, for my clients, and personally, I stepped into First Republic. The reason I did that was 2 weekends ago when Silicon Valley Bank had gone under. I looked at the financial statements and I said, this is a good bank, and it was a good bank. But what's happened in the interval is that sentiment has taken over. That sentiment has taken the form of deposit outflows that are tremendous. 30 billion of deposits uninsured from the big banks did not stop that, did not stem the tide. And so I sold it on Friday. I lost about 10%. You never like to see that in a week. Of course, it's much lower than that now. But, you know, sometimes you take a look and you logically make a trade that is overwhelmed by sentiment. That was the case here. Where I'm not backing off, though, is the Regional Bank Index. Now, let's be clear. There are risks here. There are clearly risks here that if First Republic goes, that's just another domino, and you keep the dominoes flowing and all the deposits come out of community and regional banks into the big banks. I don't think that's what anybody wants or should want, and I think there are ways to avoid that. And if it is avoided, then you've got a lot of regional banks that are selling below book value. That book value certainly has been put in peril by higher interest rates, but let's face it, interest rates have come off a little bit, and that ameliorates some of that pressure.
Down 10% in 4 days?
Sorry, what's down 10%?
No, I'm asking, that was the trade? That's not bad at all.
Yeah, exactly.
So,
exactly. I mean, I can live to fight another day.
On social media, nobody ever has lost money in any trade they've ever done. You are not allowed to lose even 10% in a trade, right?
I'll take that all day long.
The regional bank, I mean, that's interesting. Baird had
when I say I'll take, I got to be clear. I'll take that all day long because it's down 15%.
Right, exactly. Overall, you could have lost your shirt in it, and you've lost, like, I don't know.
Exactly. It was 10% or 50%. I took the 10%.
Baird had an interesting note. If not now, then when, in terms of investing in regional banks, in terms of what they are pricing in? He says what they are pricing in right now is a permanent reduction in return on assets of 40 to 50%. Which is ridiculous.
But that's the tug of war. The tug of war here in the trade is you look at the income statement, it's going to be impacted by higher deposit costs, higher regulation. You look at the balance sheet and you say, wait, there's a lot of value here in book value.
The large banks, though, have so much more excess liquidity, excess capital, almost $400 billion, and they are taking market share. They're getting deposits hand over fist from the regionals at this point in time. One of the reasons why I added to Bank of America last week, very rare to get that stock below 1 times book with a 3% dividend yield. And then a new position for me was Schwab. I haven't been in Schwab in a couple of years, but this is exactly the kind of investor that I want to be, that I am, that is blue chip quality on sale. And we know why it's on sale, but I think they're throwing out these quality companies, these excellent franchises, without really doing the homework. They could get $250 billion of excess liquidity from cash sources, and also at the same time see something like a $90 billion drawdown in deposits, which is not forecasted, but those are the extremes on both sides. And so when I look at it, I say, you know what, this is a great quality company. They are not focused on venture capitalists, which is what we know SIV was. And so, in my opinion, you know, this one was just an opportunity at 14 times earnings to add, you know, again, to all the quality banks that I have. I actually do think the 3 banks that failed, they weren't really well run. We know Credit Suisse was a problem child.
Banks don't randomly fail.
15 years we've known Credit Suisse was a problem,
right? Slow motion and, you know, implosion,
basically. Yes, and you know, and Silicon Valley Bank and the VC exposure, and then the mix on their bond book. I mean, it was, and not having a risk officer at the same time.
For like 6 months.
Come on, I mean, this is like, okay, I mean, I get we're going to have some fallout from other banks. I hope we don't, but I don't think you're going to see these kinds of really special situations that kind of went bad.
I'm with Steph on Schwab. It should almost, in my view, it should trade more like the money center banks, even though it's more of a broker than a bank. The thing that most people missed when they looked at Schwab, and they're not people that understand the difference between a bank and a brokerage, for example, a bank takes your money and literally invests it. That's what a bank does. Schwab takes your money, but you're investing your money. Those securities do not belong to Schwab. They can't use them. They can't trade with them. Your securities are your securities. So really what the issue was Schwab's own cash, its own capital. And the idea that that should trade in line with a Signature Bank or a First Republic was absolutely outrageous. So I was in that stock. I think you're going to make money with it, even though I sold it, traded it beautifully, by the way.
I expect
I think Schwab trades higher, and I think it's a beneficiary of the turmoil because if you're, and they actually told us last week they took in deposits net.
Yeah.
So if you're actually worried about your money, Schwab should not be the place you're running from. It should be the place you're running from somewhere else toward, in my personal view.